Hello everyone and welcome to Finance with JCL, the show aimed at new and intermediate level investors. And warm welcome to this afternoon, a special warm welcome to my returning viewers and listeners. So on today's menu we have a company review and valuation of Apple. This will be the first in a series of company reviews and valuations I'll be posting. Now, do remember that these are based on my interpretations and analysis. That doesn't mean to say that you should or shouldn't buy just because I'm buying or not buying. You should make your own decisions, but hopefully the explanations and things that I look at will help you in terms of the tools and techniques to review companies. So for today, to review the key financial information for Apple, then decide if it is a suitably strong company for very much long-term investments. That's the game I'm in. And then if it is, what would the buy price be with a suitable margin of safety? And then should I buy it now based on those three previous points? And the valuation method that I'm going to be using will be the cash generation method. To recap that, it will generate lots of cash over its lifetime, work out what the value of that cash is in today's terms, and then we can, based on that, compare that to the share price and see what the value's like. So perhaps the first question is why I picked Apple as the first review. And first of all, it's a company that Berkshire Hathaway holds. I believe it's its largest kind of partial holding. And that's okay. So I'm not buying it because Berkshire Hathaway have bought it. I'm reviewing it because they bought it. So this is something known as copycat investing. It's quite a nice trick. So if they're very successful long-term investors that you admire, in this case Warren Buffett of Berkshire Hathaway is one for me, you can look at what they've purchased and say, right, I'm going to look at it. I'm not necessarily going to purchase it because they have, but I'm going to look at it to see if it's a company that I want to purchase. So it's a good source of ideas. And of course Apple is a well-known successful company in its own right, so I thought I'd start with a well-known company that people can relate to and understand as part of the valuation process. So for me there are several mandatory metrics that a company has to pass. If it fails any of these that we go through, I will not invest in it. So let's run through this for Apple. So first of all, does Apple have a positive cash flow? So what that means is the free cash flow, and I've got a video on what that means, I'll put a link in. Is that positive? Because if it's not, it's generating negative returns for its owners, and therefore I don't want to invest. And for Apple, the answer to that is yes. So tick number one. Now secondly, is the net income or net profit stable or growing? And in the case of Apple, that very much is the case. And is the current ratio bigger than 1? So that means the short-term assets are greater than the short-term liabilities. And the answer to that, again, is yes. And then the return on equity, is that over 8%? So that's my minimum level, and this is an absolutely key metric. So how good is the company at reinvesting and using sort of creating value for the shareholder? So a company can pay out money in dividends, a company can buy back its own shares, or it can actually reinvest its free cash flow into the business, and that rate of return for me needs to be at least 8%. In the case of Apple, that is the case. So another ratio, so debt to equity, so this means that there isn't too much debt against the shareholder value of the company, and again that's green for Apple. Interest coverage over 6, so that's is the company at risk with some of its debt, so the interest has to pay, and again that's green for Apple. And then that net income that I mentioned before is actually positive, so it might be stable or growing, but is it consistently positive? And it is here. And then finally, and most importantly, if someone said to you, right, you can buy your Apple shares, but for the next 10 years, you're never going to get a quote on them for price, and I'll give you a price in 10 years, but would you be happy to say yes? I think there's two considerations. One is Apple sufficiently competitive, sufficiently advanced, in order that it would last for 10 plus years? And I'm pretty confident Apple will be here in 10 years' time. And then secondly, am I planning a long-term investment? If I want to sell it in less than 10 years, then I don't want to buy it. So for me, that's a yes. Now, there's a lot of terms we've just brushed on there, and I will be making some videos to explain some in more detail. In addition, I will flash up where you get this information from as well, so we can have a look at that together. Now, we kind of passed those baseline tests, so any of those 8 tests on the previous screen, if any of them were no, kind of failing or red, that would be it. I would not invest in that company regardless of any of the other attributes. However, we're now on to what I would call desirable metrics, so that is whereby, we've passed the base test, so it's at least a fair company. Now I want to see if it's a wonderful company, because I want to buy wonderful, amazing companies. And the more of these that are green, if we do end up investing, so the more of these are green, and I end up investing, the more money I'll put in because it's a stronger company. So 7R, is that net income sort of margin above 20%? And for Apple it's just over 20%. So a good profit margin. And that return on equity, where I said that base level is 8%, but I actually want a 20% return there. And in the case of Apple again, they exceed that requirement. Return on assets, so ideally that you want that above 5 or 6%, and here it's about 10% in terms of high levels, so that is a green. And another interesting one is capex requirement. So when a company has a lot of free cash flow, and the perfect example here is a car manufacturer, they actually have to spend all of that in retooling their factory for the latest model, and therefore actually the capex is so high they don't end up having any free cash flow because they spend it all on capex. And in the case of Apple, they actually have a low capex requirement, so there's plenty of free cash flow. The current ratio, that should say bigger than 2, but it isn't bigger than 2 for Apple, so it's bigger than the minimum of 1, but it's not bigger than 2, so that's an amber there, so it passes the requirement, it's not quite perfect. And that debt to equity, I said less than 2 is the minimum, and now I want it less than half, and it isn't for Apple, it's just above 1. And then finally, is this a company which is, well, perhaps you'd say in the mind, as it, when you say mobile phone, name a mobile phone company, a large proportion of people will say Apple, or name a soft drinks company, Coca-Cola, name a children's film company, Disney. So these companies that are ingrained in people's mind. In fact, the best ones where it's turned into a verb, so I'm going to Google something. That is very much a company that's in everyone's minds for that activity of internet search. So is Apple in that kind of area? Does it have a competitive moat? Does it have a reputation? And the answer is a resounding yes. So on these desirable metrics, we've got 5 greens, but 2 that aren't met. So that's not so bad. It's looking like quite a good company. So let's carry on. So have a look at some trends, and there's interest with Apple. If you look at its cash position over time, from 2006 to 2020, there's a lot of cash there. So it's got a strong element to its balance sheet there with all the cash. But we'll look at some more detailed trends. So I will put a link in the description box below for this. And this is the information found on the Morningstar website, which I highly recommend as an excellent source of information about company financials. And the reason is it's freely accessible. You don't need to log in to see this, and it's 10 years of history, so it's absolutely fantastic. I've just taken kind of clipped some of the screens to show you the key information here. So that's the net margin we talked about earlier. I want to see not just for the last year but over time, and very much that, but it's very consistent at just over 20%. It's So it's a nice, stable, profitable company. The return on assets is consistently over 10%. Return on equity is absolutely huge. So for me, a wonderful company has over 20%, and here we're at well over 50% for the last year. So that's good information. There's the interest coverage we mentioned earlier, so plenty of coverage there. The current ratio fluctuates a bit, but it's always above 1. And then finally the debt to equity, so you can see 2013 they've started taking some debt on, that's been ticking up, and that would worry me for a lot of companies, but Apple does have this massive cash pile. And then next screen on Morningstar, just above that you've got the summary of some other key financial information, and you can see here that's the net income, so that's been net profit, that's been rising consistently since 2010. It's just sort of settled now in that sort of above 50 million, so 50 billion mark. They started paying a dividend to their shareholders in 2012, and that's been consistently increasing, so there's going to be some value generated there. So that's what I look out for. And then another thing to look out for is if you look at the number of shares at issue, you've gone from 6.5 billion down to 4.5 billion, so they've been buying back their own shares. So although the company might earn more money, they're spending their money to buy their shares back, so the existing shares are worth more. So always look out for that. And then green line there, you can see the free cash flow, which used to be 16 billion, and it's now well above 50 consistently. So that's a very important figure, because we're going to use that in our valuation. So I'm probably going to use the 58,896 there in the bottom right corner. Cool, so taking all that into consideration, looking at those benchmark levels, looking at the trends, does Apple pass the test as a potential investment? And very much a resounding yes. It might be a great company, we just don't go and buy it. We have to consider what rate of return will it bring us. Now ideally I'm looking for 10% plus, but the absolute minimum that I'd accept is just under 7%. I'm just going to drop a link in here to my £1 Million Challenge video, because that is based on a rate of return of 6.66%. Now the second decision is then around the margin of safety. Shortly I'll be valuing Apple. I may make that calculation and it'll be different for somehow someone else does it, and I could make incorrect assumptions, so I'll be predicting their future growth rate and I could well get that wrong. So that's the first thing, so this is why margin of safety is needed, because we could be wrong about the company. And then secondly, to actually make a return, you want to buy a company when it's on sale. So when the value of the company, let's say it's 100, but the price is, let's say, 50, so you're getting it at below its actual intrinsic value. So for me, I either use 50% or 66% as a margin of safety. So that would mean if I think a company's worth 100, I would either only buy it at 50 or I'd buy it at 34. In the case of Apple, I would use 50% because I'm much more confident this is a strong company, whereas if it was perhaps a younger growth company with less of a track record, I might use the 66%. Cool, so we're now going to flick over to an absolutely outstanding website. So here, buffettsbooks.com, and they've got some calculators on there. Just go to the home page. Really recommend this website, it's outstanding. So it's course 3. And then we'll go to lesson 35, so discounted cash flow intrinsic value calculation. It's an absolutely fantastic resource for running the numbers for us. And it's really well presented information here as well. Cool, so the idea, just to recap, discounted cash flow, we're going to calculate the cash the business will generate until the end of its life, and then discount it back to today's value, because if it's £100 today, it's worth more than £100 in 50 years' time. So therefore we need to discount that £100 50 years' time back to today's value. So the first thing is, what is the free cash flow number to use? So I'll click this link here and type in Apple's stock ticker or abbreviation. And then that opens the Morningstar website, and you'll recognise this because it's where I showed all that key information from earlier. So it's, again, an excellent resource that links into Morningstar. And we can see free cash flow here. I'm going to use 58,896. I'll just copy that. Now, the key thing is, in the short term, which in this case we'll say is 10 years, how's that cash flow going to grow? So there's two ways to look at this. So first of all, we go to Yahoo Finance, type in Apple, click on the Analysis tab, and they're saying, wow, the next 5 years it'll grow about 11.45%. Now, they might be analysts, doesn't mean they're right, but it's kind of a good thing to look at. Now, we can estimate it here from how's that net income changed. So, net income 14,013 and 55,256 for 2019. So that was 2010, 2019. So based on the historic net income growth, that's 16.47%. Now that's bigger. That's bigger than the analyst prediction for the next 5 years. And actually, Apple's done a lot of that growth earlier on. So actually, I think the growth perhaps a little bit more limited. So let's drop that down to 6%. Stick at 10 years unless you think growth is going to slow down dramatically before 10 years. Discount rate will start with 10% because ideally we want 10% or higher. So that is the rate of return that we want, 10% a year. And then we'll say going forward, the company will grow at 2% a year after that 10-year growth period. And then finally, how many shares are outstanding? So you can see it's calculated discounted cash flow here, and it needs to divide it by the number of shares, so we can work out what a share price might be. So we go back to Yahoo Finance, click on Stats, and you've got here shares outstanding. So that's 4.33 billion, so that's 4,330 billion. And then what's it trading for? 385.31. And then hit calculate. So what that's telling us is the intrinsic value per share based on this information is $226.96. So therefore, if you factor that in, it's saying if you're aiming for a 10% annual return, you're actually going to get 6.93% based on the current price. Now, if we change that to the base value of 6.66%, that's the return we want, we change the discount rate, hit calculate. It's now saying, right, $409.55. So therefore, that's actually saying the company's worth slightly more than its market price if you're going for that. Okay, so in summary, we're looking for a 10% return from Apple. The intrinsic value of the cash it will generate means per share the company's worth $227. We want a margin of safety of 50%. So therefore, the buy price is $114 rounded. Now, the current market price is $385, so about 3 times higher. So therefore, in theory, do you buy it? The answer is no. But what about with the baseline 6.66%? So the intrinsic value there is $410 a share. Again, we'll go for 50% margin of safety. and therefore the buy price is 205. So again, in theory, don't buy this company because the market price of 385 is substantially higher than the 205. It's really important. So we want to buy things on discount. We want to make sure we've got an allowance for incorrect calculations or unexpected economic events. So it's very important for me to stick to my disciplines and always keep that margin of safety of at least 50%. So I know what I buy, I've got that confidence and built-in safety. Because rule number one of investing is do not lose money. And if you don't have a margin of safety as big as 50% or more, there's a much bigger chance you'll lose money. So that's why it's there. So what's next? I think it's very clear for me that Apple's best in my existing stock portfolio. It's a very high quality company. And that's something to consider when you're buying, valuing shares, is it may pass all the tests, but actually if the companies you've got are already better than this, or score even more highly, why would you buy it? Because let's say Apple's the 10th best company. In fact, you might think, well, my first and second best companies are that much better. I'll put more money into those if the price is right than putting it into Apple. So think about that. So it's better than most of my existing stocks. However, I'm not going to buy it because it's margin of safety versus market price. There's that discrepancy. So instead, I'll add it to my wish list. So that is a list of stocks whereby I've reviewed them, I've confirmed they're outstanding companies, and I've put the buy price in. So I know what I want to buy them at, it's just that the market hasn't hit that lower price yet. And in order to make sure I'm aware of that, I'll set up an alert so that I get emailed whenever the price threshold is triggered. And I'd recommend you do the same and have the same kind of setup. So that if you know you want to buy a company at a certain price, set an alert up so you don't miss the chance when it hits that price. So in summary, we've looked using the cash flow generation method as to how Apple may fare in the future. They pass all of the mandatory tests and they got strong performance in the desirable metrics. However, their market price is above the buy price for the margin of safety, so it's been added to the wish list. So, thank you very much for listening in today. I'd be grateful if you could support the channel by subscribing, and therefore when I perform my next company review, you'll be able to get wind of that and notified of that. And then please hit the like button if you found this video useful and it's helped you in how you review companies. So thank you very much and see you next time.